When it comes to financial education, it's really up to you to take charge. Now, in today's video, we're going to be looking at this week's entire compilation, including videos like 7 reasons you shouldn't invest with a billionaire, and of course, where to put your money when rates are increasing. So let me know in the comments what you guys think. Like the video and definitely subscribe to the channel. Share the content if you enjoy it and enjoy the video. What is your portfolio comprised of? As we dive into the world of investment, we're going to be looking today at the S&P 500 funds and also looking at global ETFs. Now, a lot of people will kind of break it apart. They'll invest some in the S&P 500, then they might hold some international ETFs or some international stocks. But what really does come out on top, and I'm going to show you through a little bit of analysis why exactly I invest how I do. Now, when it comes to building that successful investment portfolio, one of the most critical decisions that you have is how do you invest the money that you have? Are you putting it in ETFs? Are you going for stocks? Are you doing cryptocurrencies? Are you buying long, shorts? There's a ton of things that you can do. For me personally, most of you know if you follow my channel, I invest in ETFs and only in ETFs. Now, a lot of investors really do struggle with the two options and what is right for you. There are advantages, there are disadvantages that you can come across. When you start looking at just the S&P 500, you have exposure to the US markets, which is considered one of the most developed and the most stable market in the world. On the other hand, when you start looking at global ETFs, having a more diversified portfolio that is not just based in the United States only, which crosses a variety of regions and asset classes, could also be appealing to a lot of other people. The dilemma is further complicated by the fact that both options have, again, some unique benefits. They do have some drawbacks. When we start looking at the S&P 500, it is the benchmark for the US stock market. Warren Buffett has said everybody needs to be investing in the S&P 500, and the S&P 500 through the VOO is specifically what I do hold in my portfolio. But a lot of people like to see the levels of diversification, getting outside of the US markets just in case anything should happen. And we don't know what's happening with our new president, but only time will tell on that note. On the other hand, global ETFs can offer a lot more diversified portfolios because they have exposure to these global markets. But ultimately, the decision between investing in that S&P 500 or the global comes to an investor's goals, risk tolerance, investment strategy that they're using. By understanding really the pros and cons of both of these, you can make a more informed decision about which investment route you're going into. So let's go ahead and look at these and kind of compare them side by side so you can take a look and make a more educated decision. All right, guys, so here we are over on ETF.com. I want to compare the VOO or the Vanguard S&P 500 Index Fund to the VT, which is the Vanguard Total World Stock ETF. That is right, you can invest into an ETF that is the entire world stock market. It is everything that we have that you can invest in rolled into one ETF. Now, looking at the overview of this, I want to do a side-by-side comparison. Looking at really the issuer we know as Vanguard, expense ratio with the VT is double what we see with the Vanguard S&P 500 fund. And overall, the assets are about $500 billion more with the VOO in comparison to the VT. Even looking at the daily volume that we're seeing, 2.25 billion versus 140 million. So not a lot of money into this ETF, that is the global fund or the world stock, and not seeing a lot that is really following it. The big difference that we see right here is the holdings. When we start thinking about the US companies, we are holding 506 companies. When we start looking at the world stock is almost 10,000 different stocks together, which again is pretty impressive. When you start thinking of investing on an international scale, investing outside of the US markets, we have almost 10,000 companies or 10,000 holdings that are publicly traded that we do have access to within this world stock ETF. And again, it's kind of crazy to think that one ETF you can invest in everything. But how does it match up comparison wise? When we start thinking of the US markets, a majority of the markets within the United States do make up the global market itself. I believe we're roughly 50% of the global market itself. So even putting something into the VT is going to have a majority of your money still based and really invested into those US companies. But then we get into the performance. So looking at the last 12 months, we're starting here on November 23rd, going all the way to November 20th of 2024. So in the past year, you can see the VOO performing 30.43%, Well, the VT is at 22.09. So the global markets are actually severely underperforming, still growing pretty well, but are definitely underperforming what we're seeing in the US markets. And you can see that is about an 8%, just north of an 8% difference when it comes to these funds themselves. So if I would have put $100,000 in the VOO versus the VT, I would have seen a much higher growth rate of 30%, which again is not regularly for the S&P 500 funds. It has been an absolute tremendous year for investing in general, regardless if you're buying Bitcoin or you're investing in the markets, it has been doing incredibly well. But when we start looking even further back, so when we start panning out, looking at these ETFs in their entirety, even over the 1 month, you can see that VOO doing incredibly well. 3 months still beating it out, even year to date, significantly seeing a gain there. I mean, you're looking at almost a 5% difference. And then even here, 1 year, we're at 34.5 versus 28. So again, you can see the gap is starting to get a little bit wider when it comes to the diversification through here. When we look back 3 years, you can see we're about 3% higher, 3.5% higher. Even going back 5 years, even going back 10 years, the VOO or the Vanguard S&P 500 fund has outperformed this over the last decade. And when you start thinking about the compounding of building this, the S&P 500 has yielded 13% over the last decade. That is crazy. And it continues to bring up the average when it comes to investing in all of those large cap companies. And this, of course, is a big push from artificial intelligence and really the rise of AI that we're seeing right now. And in the global markets, again, it is lagging a little bit behind. You're looking at about a 4% differentiator there between these funds themselves. But then we look at the holdings. This again is where if you're thinking you're putting money into this world fund, you're going to be invested in everything, not really as diverse as you think. So when you start looking at these top holdings, we have Apple, Microsoft, Nvidia, Amazon, Meta. They are identical over here. The reason for this is because they are market weighted caps. So the larger that the company is, like an Apple or a Microsoft, the more the company is going to hold, or the more the fund itself is going to hold of that company. Now, again, when we start thinking of the growth factor, when we start thinking of artificial intelligence, the US markets have been doing incredibly well, and we're still seeing that continuing. Now, overall, with the VT on this side, you can see even when we get through almost all of the top holdings, this is the only one that actually gets into a company that is based outside of the United States when we start looking at the Taiwan semiconductors or manufacturing. And this goes to less than 1% of the holding rate here in the bottom. Again, when you start breaking it down, even though they're not holding as heavy that we see, again, of the tech sector of these large market caps, when you start looking at less than 1%, to get all of these companies within this fund itself, we're talking 9,600 companies, it is down to such a minute fractional share. I mean, even looking what we have 1, 2, 3, 4, 5, 6 companies that are just north of 1%, meaning when you start getting to the bottom of your 9,600, you're going to probably own a 0.01 or 0.001% of these international companies. Now, when again, we start looking at the comparison, electronic technology definitely driving when you look at the breakdown of what the sectors look like. ET or the electric technology is driving it. By technology services doing incredibly well. Finance, outside of here, VT is outperforming in the finance sector. And that is actually one of the only sectors that we are seeing that outperform, even looking at, healthcare technology, retail trade, some consumer non-durables and manufacturing outside of the United States. Again, doing a little bit better, outperforming, but there is so much that is offered within the sectors that are kind of the largest cap. I mean, you're looking here, this is at 22%. Versus 15 overall. And when you start looking at it, and one of the big things that I think is when you start, again, kind of breaking it down to where these companies are, how they are invested, you can break it down in a lot of different ways. But overall, when you start looking at international stocks and international ETFs, is it really worth it? So when we start looking at the historical performance, the risk factors that it has, the potential return that we're seeing in that S&P 500 and those global ETFs, it seems like it does make a lot more sense to really invest in the US markets itself. When we're looking at the returns, even over the last 10 years, you can see exactly how there is starting to get a larger gap within the markets themselves. And like I had said, when you look at the US markets, we are about 50% of the global market in its entirety. And I feel like in the future, we're going to see it really continue. Now, a big note to remember, and the reason why I do not invest in global ETFs and I do not invest internationally at all is the reason because when you start looking at those larger companies, when you look at Apple, when you look at Nvidia, when you look at Google, when you look at Meta, those companies operate in pretty much every single country outside of the United States itself, meaning that you're still going to have international exposure, even though you're not bought into the international markets or you do not own pieces of international companies. They still have a global presence, which is really dominating, and being in every market, in every country does make a big difference. When you start looking at companies like Starbucks that are all over the world, McDonald's, even Burger King, they are in a multitude of countries and really have a global presence, which will impact how the stock performs based on how they perform in a global market. So looking at my analysis, does it make sense to invest in those global ETFs? They do offer more diversification through a portfolio, could have a potential or a higher return if the global markets do see a big downturn. But in conclusion, guys, when you start looking at investing in that S&P 500 versus the global ETF, it comes down to really whatever your goals are and where you want to put your money, what your risk tolerance sits at. But like I said, personally, I do not invest in any of the global markets because a lot of the large S&P 500 or the large market weighted cap companies we see are in a global aspect. Now, of course, also when it comes to the pros and cons of this, or when it comes to breaking it down, you have to do your research and know exactly what you're investing into. There is no point in time that I want to research 9,600 companies. Sure, I'll go ahead and do my research on the top 10 companies, really being a lot more in tune with them and knowing exactly what they have to offer to an investor and what they're coming up with on a global site. So guys, that is going to do it for today's video. Let me know in the comments which investment you prefer if you're investing in the S&P 500, if you're looking at international or global markets, and exactly how it's working out for you. And of course, if you want to learn more about my investment strategies, things that we're talking about, definitely subscribe to the channel and I'll catch you in the next video. Are you part of the 1% of Americans that have a really high annual income? Today's video, we're going to be breaking down the income for the top 10% and the top 5% and that top 1% to see exactly where you fall. Now, when we start looking at the United States, the median income is roughly $70,000. Now, this is going to vary greatly depending where you live. If you live in Nebraska, $70,000 is a lot different than if you live in California, where you probably couldn't even afford to buy anything. So when we start breaking this down and looking at a comparison of income, the incomes of the top 10%, 5%, and 1% are as follows. 10%, you're looking at $268,000 a year on an annual basis, so pretty good. You're making $250,000. When you start looking at that top 5%, you're looking at $390,000, so a lot closer to $500,000. But when we break into that top 1% of income earners in the United States, it is $1.2 million is that sweet number. And on an annual basis, that is kind of crazy. When you look at the difference between the brackets, top 10% to the 5%, you have to add on another $140,000 on top of your annual salary to even get into that 5%, which is kind of crazy when you think in relative to how much you're getting. Now, of course, we can break this down and segment the data a lot of different ways, including breaking down by age, not just by percentage. So when we start thinking of the income of the top 10% by age, under 35 brings you to 146,000. When you start getting up to my age bracket of 45, 45, you start looking at 310,000 a year to be in that top 10%. When even you get north of that up to 65 years of age, you are looking at 254,000. So it does go down a little. And of course, that does give you the average of where we are for that top 10% of income earners. So when we look at this 1%, very interesting. So if you want to be part of that 1% under the age of 35, you're looking at 465,000. So under the age of 35, you're producing almost $500,000 a year, which is kind of crazy when it comes to the income. Now, as you get a little bit more settled in the career to be that 1%, when you start looking at the age of 45, you're at $1.38 million. When you start looking at 55 plus, you're at 1.5. even looking at 65, $1.55 million that you're getting on an annual basis. Now, when it comes to income, it's really cool to look at it, kind of looking at a comparison of where you fall compared to, the top, again, 10%, that 5%, and that 1%. But does income really matter? Honestly, when we start looking bigger picture, when you think of people who hit the lotto, you look at celebrities, you look at sports stars, you look at a lot of these $1 million income earners that are completely bankrupt. It is kind of crazy to think that you can have an exorbitant amount of income and still be completely bankrupt in your personal life. There's much more than just that income to be successful. We're going to be breaking those down. Now, earning an average income can certainly help you financially the more money you earn, but a lot of times it is not everything. It is about how much money, what your net worth is, and what your savings rate is. That is really going to build you and build you wealth over a generation. So when you look at saving money and looking at income, you save money every single month. This is one of the big things. When you start thinking bigger picture, when you start thinking of our three buckets we talk about, where the first one is your income. So let's say you make $500,000 a year. Second one is your expenses. This is going to be the bucket that is going to make the huge difference in your life. If you're an individual making $500,000 a year and you're spending $500,000 a year, guess what? You don't have anything for IRAs. You don't have anything for 401ks. You're not saving anything at all. You have to save money. And you have to save money. And when you start thinking about kind of the compounding interest and the exponential factor, where if you're, again, an individual that earns $500,000, if you're saving 15% of that income, you are going to exponentially increase your contributions up to that 15%, meaning a big chunk when it comes to contributions, when it comes to capping out, your 401k, your HSAs, your IRAs, everything for that with a high income is going to be super easy, not even going to hit that 15%. And then the rest of it can go in brokerage accounts, a lot of other places that you can put it. And again, it's about not only the money that you generate, but it is about the money that you're keeping. When we start thinking about retirement, automating everything at this point, even personally, again, if you're making 50,000 or 500,000, the automation, the investing process, that is the way that you can go ahead and you can invest a little bit of money at a time, and you can see gigantic returns when you actually get to retirement. When we start thinking of 401ks and IRAs, they are the good option to put your money into. Now, of course, this doesn't really clean the slate, regardless of how much you make. Having an emergency fund and making sure either that or you're working towards it is going to be imperative. Having enough of that emergency fund to cover 3 to 6 months of savings is imperative if something should happen. If there's a job loss, if there's anything that happens in your life that requires additional funds, you have the money available. This keeps you from borrowing. A lot of people that we see why they're looking at bankruptcy, why they're going, a lot of different routes, is because one, they don't have an emergency fund, and two, they're carrying a lot of debt. Even if you have the money, a lot of people are carrying an exorbitant amount of debt, which again, some of it I don't understand as a financial counselor. When it comes to having the money to pay off your debt, I would rather have that paid off debt than sitting on a bunch of money in the bank, because that debt is eating up interest. You have to realize when you are a high income earner, if you're in that top 1%, exponentially things get more expensive. You're not going out and buying, a new GM, a new Chrysler vehicle. You're buying a Ferrari, you're buying, a Land Rover, you're buying a much higher end product, which comes with a much bigger interest payment. Not only the payment itself, but also the interest that is generated on that. But living a different lifestyle doesn't have to be so exorbitant with the amount of money that you have. And of course, having money left over to spend on yourself. This is something that I feel when it comes to budgeting, when it comes to financial education, you have to make sure you take care of yourself. You are the income earner. Savings is important. Investing is very important, but you have to have some fun money. You have to have the ability to live your life, or a lot of people are going to start questioning exactly the reason before it. It is taking vacations. It is treating yourself to things. Really, your mental state of mind and your ability to produce the income is really reliant on what you do as an individual. Taking care of your health, taking care of your body, taking care of yourself gives you the ability to work and gives you the ability to work at a very high level. Now, high income earners can be a very impressive achievement when it comes to additionally earning money. 10% sounds amazing to be in, 5% sounds amazing, but income does not tell the whole entire story. When you look at someone that's making $500,000 a year, let's say you're that top 5%, and you could be working 80 to 100 hours a week, which we see, life feels miserable. It feels horrible. Even though you're generating a lot of income, it really makes a difference, the quality of life. And that's really what you do have to remember. Regardless of where your income is, what does the quality of life look like? Also make sure that when you're raising your income, that you are investing more. If you're getting, investing 5%, you get a raise, bump that to 6%, go to 7%. By the time you get to the point of having 15 or 20% of your income investing, it is on autopilot. It is very easy to generate wealth and really build wealth when you're putting money on a consistent basis into those retirement accounts, and it'll make a difference. The future you will really thank you when you get to the point of getting ready to retire and you have the funds and you have the means to not go back to work after you retire. It will make a big difference. All right, guys, so that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you for watching. Who doesn't want to be a billionaire? For the fortunate few who have really achieved this financial pinnacle, they can be completely financially free. But for you and I, it might be a different story. When it comes to those billionaires and managing wealth, it might not be in our best interest to follow the exact steps that they do. Certain moves really don't make sense. Now, according to the famed financial expert George Kamel, billionaires are not like the average person. And when it comes to investing, we should not invest as billionaires do, because there are a couple caveats that they have. Now, the first one, billionaires invest for preservation more than growth. When we think of Warren Buffett being in Bank of America, being in Apple, being in Coca-Cola, those are more about the preservation of wealth, getting that income dollar, getting those dividends out of those companies, make a really big difference. Billionaires have unlocked the absolute highest wealth status that we know as a nation right now, and they're concerned about preserving that wealth while still growing a little bit, but not growing it like we do. When it comes to complications, when it comes to tax strategies, estate planning pools, there are a lot of reasons why they have an entire team of people to help with their wealth preservation and, of course, paying for those people. Billionaires put their money in trust to help protect the wealth for future generations, so the kids are going to enjoy it as well. And, of course, utilizing those charitable donations to have some massive, heavy tax write-offs. Now, we see this with Mr. Beast. We even see it with some of the larger content creators. When you start looking at the philanthropy part of it, there is a big reason why the donations go out. When you get to that billion-dollar status or enormous amounts of wealth, giving money away not only is great, it really helps society. A lot of the donations for something that you care about or something you're close to, but it is also a massive tax write-off. Now, the second one we look at, billionaires are focused on private equity or venture capitals. This, of course, is not available to you and I. When you started thinking of like Masterworks, where now they give you access to fine art, before that was locked behind really a paywall that you didn't have the ability to. You're not in the meetings to have premium access or private deals with different companies. And it makes me think back to 2007, 2008 with the housing market crisis, where Bank of America was in need of funds. They turned to Warren Buffett. Warren Buffett gave them the money they needed. But the caveat with that, Warren Buffett said, I want a 6% return. There was nowhere in the world at that point that was getting a 6% return. He wanted a guaranteed 6% return. And through the venture capital or the private equity deals, he made that work. Now, when you start looking at private equity firms, they raise a ton of money from big investors. When you look at corporate investing, when you look at even the private investing, big companies and buying companies, we've seen this from cutting costs, improving operations, changing in leadership, even taking companies into the public realm. And of course, the biggest one that we've seen of this is Shark Tank. Shark Tank was starting with the startup companies, billionaires researching young companies that were in the startup phase and really investing in them and getting a chunk of the company up front, knowing that if they take 10, 20, 30, 50% of a company, when they start dumping money into it and when the company starts growing, they can reap those profits out of there. And for you and I, we do not have billions of dollars to invest or even millions of dollars to invest in that avenue. Now, billionaires have a much higher risk tolerance. This, of course, comes with money. When you think of the risk tolerance, most of us will take a very minimal amount of risk. I'm kind of risk averse, I guess, not looking at like doing just bonds, but looking at ETFs, having that diversification. But when you start thinking of billionaires, it really comes down to how much money do you have? Again, if I have $100,000, if I lose 10 grand, that is a really big deal. If I have $1 million and I lose 10 grand, not quite as big of a deal. If you're sitting on $1 billion and you lose $10 million, doesn't even really, not a drop in the bucket when you're sitting on $1 billion, which again is kind of crazy, but it is the scaling of the assets that makes a big difference. When you got billions, you can stomach any risk, or really the high risk. When you look at hedge funds, when you look at tech startups, when you look at investing into something risky like cryptocurrency or even going into Bitcoin, losing or putting a lot of money in there could have a tremendous upside. If you're putting $100 million into Bitcoin, all of a sudden it shoots up and it's at 94K right now. Guess what? You might have made millions and multiple millions of dollars, depending when you got in, just from one single investment. Now, also when it comes to billionaires, they can absorb financial losses that would absolutely crush us. Again, when you think about billionaires, not only do they have the ability to absorb the loss because they are financially really savvy, but not only that is they have money. They can effectively lose millions of dollars, be completely fine. Regular investors like you and I, if we see the stock market go down 50%, that can be absolutely devastating to our finances, devastating to the ability to invest. And of course, we have a 9-to-5 job. When you start looking at billionaires, they can also get really big loans for a very, very cheap amount, which is kind of crazy. Now, billionaires and everyone else, they have access to loans and really an infinite amount of money if they needed it to, at a very low rate, depending where they are. You have wealth managers, you have banks that are ready to hand them cash on a regular basis, really backing whatever they want to do. For an average person, we have to use our credit score. We have to go ahead and use, spending value. There's only so much we can invest. There's only so much money that we could even borrow if we wanted to invest. We're looking at a billionaire. If you went in and said, hey, I need $50 million to invest in this startup, boom, they would go ahead and give you that $50 million. You'd be all set. If the startup does incredibly well, guess what? That is wealth in your pocket. Now, also when it comes to billionaires, and this is one of the big important parts, when it comes to investing and when it comes to the influence on the markets, when you look at really some of these giant investors, when you look at your Elon Musk, when you start looking at some of the political arena, when you start looking at Warren Buffett, one reason you can really emulate, or it seems like the markets move when billionaires invest, it is because they have the influence to do it. This is the reason why when you see Bitcoin skyrocketing, and you see it everywhere, I see it on social media, I see it, in the news, I see it online, I see it everywhere. Bitcoin is just exploding everywhere in the news. That news and that drive and that huge influence that billionaires can hold really can drive up a market. When Warren Buffett says he's selling out of a position like Apple, which he just did, the Apple stock will take a little bit of a tumble because when they declare a stock a sell, or when they go ahead and they do it as a buy, like when he bought a lot of Bank of America, or a hold like Coca-Cola, again, you can kind of influence the market and influence not only the market by what you're doing, the moves that you're making. When you start looking at a company like Berkshire Hathaway, if they're liquidating their position in a stock, there's a darn well reason that they are, and a lot of people do follow that. And the final one that we look at, billionaires have far less pressure to diversify. This, of course, when you start looking at multi-millions and really looking at the diversification, there is a little diversification, but not a ton. They really don't have to diversify. When, again, you think of a company, like Coca-Cola, where you might have $300 million parked with Berkshire Hathaway, that makes a big difference. You're raking in, and I believe they said around $19 billion a quarter in dividends that are coming out of companies. For me and you, average investors, we have to diversify. If we see a sector that takes a tumble, it can devastate our portfolio. And if you're an individual that still invests in individualized stocks, I do not recommend it all. There are a lot of investment advisors, financial advisors that are in the same spot that I am. When I start looking at ETFs, it is how I invest all of my money. I do not buy individual stocks unless I'm kind of playing around with them, maybe a very low, $500 to $1,000, really that I could stomach the loss if it went south. But overall, the majority of the portfolio, all into ETFs. It gives me the diversification. It gives me the hands-off investment approach that I'm looking for, just putting money in there on a regular basis, and it is growing exponentially. Even if you look at the S&P 500 this year, doing incredibly well. All right, guys, so that is going to do it for today's video. 7 reasons that you should not invest as a billionaire, according to George Kamel, which I absolutely love, Dave Ramsey, and I love The Ramsey Show. So guys, that's going to do it for today's video. Let me know in the comments what you guys think, and I'll catch you in the next video. If you can't beat the market, you might as well buy the market. There's a really big reason to adopt in buying the S&P 500. And in today's video, we're going to be looking at the SPY. Now, when we start looking at the last 14 consecutive years, a majority of actively managed large cap ETFs have lost out to the S&P 500 and have lost out in a very big way. It's very hard to outperform the benchmark, and a lot of people, even that can do it for short term, when you start looking at a multitude of years, they cannot outperform looking even at the best computers, algorithms, researching data. Humans don't seem and cannot outperform this S&P 500. So what is the Spider S&P 500 ETF Trust? That is what we're going to be breaking down today. So looking at this ETF, it is the oldest and it is the largest ETF that we have, and understanding exactly how it works. Now, the ticker symbol on this one is SPY. It is run by State Street Global Advisors. It is the first ETF ever. This is the ground floor. This was number one. It tracks the performance of the S&P 500 index, comprised of the 500 largest companies in the United States. Now, the catch with this is when you start thinking about the market weighted cap, when you start thinking about the market in a big picture scenario, the top 10 holdings in here, you will know the names, but you want to know, and it's important to know the weight. When we look at Apple, it is around 7% of this ETF. So thinking of diversification wise, where if you just have this 100% pie, when we start looking up Nvidia, Microsoft, Amazon, Meta, Alphabet, Berkshire Hathaway, Broadcom, Tesla, just looking at these themselves and looking at their market cap weight, they are trillions of dollars, and they create about 30% of the S&P 500 just between those companies itself, which is kind of crazy to think that they have such a large part of the market. But also when you think about what they do and what they fundamentally do, they are in every country. They are global companies, with the introduction of the web, with the introduction of artificial intelligence, which is still, in my opinion, in the infancy stages. It's going to make a really big change and a really big difference for years to come. So when you start looking, and this data was compiled by Crestmount Research between the 1900s through the end of 2023, looking at 104 consecutive years of positive returns. Think about that. Out of 123 years, which again is kind of crazy, we have seen 104 years of consecutive positive returns in the S&P 500, which is crazy, or in the market itself. So when you look at the S&P 500, it wasn't created until 1957. So they kind of back tested the ETF using a rolling 20-year average, including the dividend payout, which we know dividend payouts are a big part of the combination and of really the compounding that we see within ETFs. So when you start looking at it, it is a super plain vanilla approach to investing. If you choose one ETF, like the SPDY or the Spider, overall the Spider S&P 500 ETF, it is going to invest you into every sector, which again is kind of easy to do because when you're putting money in there, don't have to worry about diversification, don't have to worry about anything else. It's kind of crazy when you think about investing. But of course, when you also start thinking about this, only a handful of stocks are doing the very heavy lifting within the S&P 500. And if you've heard the conversation about the Magnificent Seven stocks, the S&P 500 has enjoyed a crazy year this year so far, which is up over 25% since the last bull rally. Starting late in 2022, it has gained 66%, which again is kind of crazy to think. The economy is good, relatively speaking. Inflation, they've got it kind of under control. I believe last I seen, it was around 2.3%. Interest rates still a little bit too high, but the Federal Reserve is slowly moving those down. And the reason for the forecast, a lot of people think of the Magnificent Seven. That is comprised of Nvidia, Microsoft, Meta, Alphabet, Apple, Amazon, and Tesla. They are resulting and they really responsible for about 50% of the gains this year, which is kind of crazy. As the end of October, 7 juggernauts make up 1/3 of the S&P 500 by market cap, but are responsible for 50% of the gains, according to Bank of America. That's the reason why when you start thinking of these companies and when you start getting into these very large tech companies, it's important to know putting money into something like this is instant diversification. You are going to be spread among all of these different industries. And even though, again, when you think about the market itself, the US markets are about 50% of the global markets. Of that 50%, 80% of this is the S&P 500. So again, when you start thinking about investing into individualized companies, when you start thinking about where it is kind of headed and how the index trades and how the index works, these companies in the future, I feel, are going to be much higher. putting money into something like this ETF. Me personally, I put money into the VOO, which is the Vanguard S&P 500 ETF. So very similar, they track the exact same identical index. A lot of people say to do this one because I believe it is a 0.01% cheaper when it comes to the cost. But overall, looking at the valuation and what the price and earnings ratio is also important, because when you look years ago, it was about, 19, 20%. Today, it's gone well over 30, and it continues to climb when you start looking at these huge Magnificent Seven companies that are doing incredibly well. When we think of companies like NVIDIA, that is posting around a 2,600% return in the last 5 years. Yes, I said that right. 2,600% return over the last 5 years. It doesn't seem like the momentum is going anywhere. It doesn't seem like, especially having a new president, that it's going to be a lot more about big business. When the price comes down, when the Federal Reserve lowers interest rates, it makes money cheaper. It gives the ability for smaller companies, it gives the ability for larger companies to borrow more money at a discounted rate, meaning that they can borrow an absorbent amount of money or a ton of money at a very cheap rate. And that, of course, is going to slingshot out of artificial intelligence when they're starting to look at some of these companies building nuclear reactors because they require so much power to run the cloud computing, to run a lot of different things. It's kind of crazy. When you think of buying, any of our ETFs that really track the S&P 500, it doesn't make sense to not buy something like this. It's kind of crazy. When you start thinking of stocks, there is shorts. People are shorting stocks. They are longing stocks. There's a lot of different things which markets can remain really irrationally longer than they can solvent. They can be around for a ton of time. And again, thinking of how far the market and the investments in companies goes back, it's kind of crazy. Second, the bear markets are short-lived events. They tend to be measured in months, where bull markets can go on for a multitude of years. Every single bear market has been followed by a bull market that wiped away all of the losses experienced and has gone to new highs almost every single time. Even looking this year, we have seen a multitude new highs to the S&P 500. We've seen a lot of new highs to the NASDAQ, to the Dow. We have seen an incredible amount. And even if an ETF tumbles, if the ETF goes back, even if they draw back, guess what? If you are dollar cost averaging into these ETFs, you're buying it at a discounted rate. For me, it is really something, and Black Friday is tomorrow. Today is Thanksgiving. Happy Thanksgiving to you. But if you're looking at buying something discounted, when the market starts pulling back, that is the time you need to be investing more money through dollar cost averaging, because overall, you're going to get more bang for your buck. If you're looking at and consistently buying into the market, when the market is going down, as soon as it turns around, which it always has for all of history, it is going to be impressive with the returns that you see when the market does do that turnaround. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching. So you spent a majority of your adult life planning for retirement and saving for that special day. When it finally comes and you retire, what process is going to change and what plans do you need in place to ensure that you're not going to run out of funds? Now, this is something that I put a lot of time and effort into, because overall, I don't want to get to retirement, be 5, 10, even 15 years in, then have to go back to work because I didn't plan properly. So in today's video, we're going to be looking at a couple popular strategies on how to really manage the funds. Some of them a little more controversial than others. And starting with the first one, which is the 4% rule. Now, this one for me is very interesting because some people have said, even I know Dave Ramsey has gotten a lot of criticism about saying that you can take 8% out, you can be absolutely fine. But the 4% rule is very tried and true. This ensures that you don't run out of money during retirement. With the 4% rule, you withdraw 4%. That's right, 4% of the account balance in the first year. Then you adjust future withdrawals for inflation. Now, this is where it does get kind of crazy, because if you think about inflation, if you have an account with $1 million balance, the 4% rule or the 4% withdrawn the first year would mean you're getting $40,000. Now, the $40,000 that you're getting is to supplement Social Security, but you're only taking and really removing that $40,000. If inflation was at 3%, you would increase your withdrawal by 3% in year number 2, giving you $41,200. So a little bit higher than that 4% overall. By adjusting your withdrawals for inflation, it really helps preserve the buying power because you're not taking too much out. When you start looking at this rule, and again, thinking of the 8%, what Dave Ramsey was talking about, if you're looking to take that much out of a $1 million portfolio, the first year you're taking out 80,000, you are going to be out of money very fast if you start taking that 8%, continuing with the 8%, and then of course going and taking more out from that due to inflation, it's going to go down pretty quick. Now, the only downside with this 4% rule is if you withdraw the money when the stock market declines. This is something that you really have to be cognizant of and what you have to think. If we look back, even looking at 2021, where the stock market was down 20%, if you're taking 4% out, that really, it's hard to recoup those losses because you took those losses out. You took the money out when the stock market comes and starts recovering, like we see in 2022, 23, 24, you're not going to have that money in there because you did take that 4% out. But of course, the 4% tried and true rule has been really in effect for decades, and it has worked incredibly well. Now, the strategy that I'm looking at that I am most vested into is the fixed dollar strategy, very similar to our 4% rule without considering inflation. This really pegs on how much money I need on a monthly basis. This is the reason why when it comes to budgeting is so expensive. So let's assume you're 70 years old, you have that $1 million account and you want it to last until you're 100. You can take around $33,000 a year, and through the growth factor that it should grow, you should be able to essentially last for 30 years on the withdrawals that you're taking out there. This, of course, makes it very easy. So if I'm saying, hey, I get 28,000 from Social Security, I want to take out 33,000 out of my retirement plan every single year. The combined total of those have to be greater than the amount that I'm spending. So that is imperative to really know. You can't go in with a fixed dollar strategy if you're taking $50,000, $60,000, $70,000 out of your $1 million account every single year. All of a sudden, you'll quickly realize that 10, 15 years later, you've depreciated and all the money is out of that account. And of course, if we have a year or two that are down, that is going to go much faster. This is a very simplified and a very popular method because it is very easy, but it can make a big difference when you start really calculating inflation. When you think of today, if you have $30,000 today, in another 5, 10, even 15 years, that same $30,000 is not going to buy the same goods and services that we has as today, which of course is really, if you're doing this for a prolonged period of time, I know Social Security is going to be adjusted for inflation, but through this withdrawal method, you are not going to be adjusted for inflation. Now, the next one we look at is dividend withdrawals. This is another one that a lot of people have talked about, including Dave Ramsey. When you have a sizable retirement fund, we're talking like $2, $3, $4, $5 million. You can go ahead, withdraw your dividends that are coming, your interest that you're earning, and live off that in its entirety, meaning you are going to leave your principal intact. Now, this again is another theory that I've heard from a lot of different people, including Dave Ramsey, when he talks about you don't want to kill the golden goose, you only want the eggs. This ensures 100% guaranteed if you stick to this method that your account not only is going to grow over time, but you are never going to run out of money because, again, inherently, you're not taking out the principal. If I have a $3 million portfolio and I have those dividends deposited into my personal account, that portfolio going up, going down, whatever growth method we have, I am only taking the dividends in the entirety. Now, of course, with this one, there are two big downsides for this, and it makes a big difference when you look at the annual withdrawals. They could fluctuate, making it a lot more difficult to budget, which is huge. And of course, depending on the account performance, you might want inflation, and it could be concerning again, depending on where inflation is. If it's at 2%, if it's at 3%, great. We know everything's good. We know retirement is going to be well. But when we start thinking of 5, 6, 7, 8, almost 9% inflation, that can be devastating when it comes to consumer price index and how expensive these goods and services have been getting. Final one we look at is the bucket strategy. This, of course, is breaking it into a couple different buckets. And this, again, is where it really got my mind thinking. And when it comes to the bucket strategy, there's really 3 separate buckets. And that's exactly what we're going to have when I come to retirement. First bucket is mostly cash equivalent. This is the money that we have in those high yield savings accounts. This is the money, not the set aside emergency fund money, but this is fund and really money that we have sitting aside. This is going to cover living expenses for the next couple of years. The second bucket is going to be really that retirement income that we're going to have to take. When we start looking at the traditional IRAs, the traditional 401ks, And then we start looking at the Roth variation. And of course, the second bucket, like we talked about, is going to be the fixed income. That is going to be the securities. That is going to be the bonds. It could be CDs, but it is also going to be something that is going to come with RMDs. We know as of right now, they move the age to 73. So when I get to 73, I am going to be required by law to start taking our MDs, or required minimum distributions, out of my investment accounts. Now, of course, the final bucket and the last bucket would be that Roth after-tax bucket. But systematically, when you start thinking of this, when you start thinking of bucket number one, using our CDs, using the high yield savings accounts, using that money to supplement some Social Security, that is the lowest, the absolute lowest paying dividend money that you're going to have. When we look at that second bucket, that's starting to get into those investment funds. That's starting to get into the IRA money. But again, you are required by law to take them on the RMDs. And the final bucket, if we do get to that very last bucket, is going to be our tax-free growth income. And of course, all the money we take out of there at that point is going to be completely tax-free, because that's going to be the Roth variation. So it is a really good strategy. But with this final strategy, with the bucket strategy, it does take a lot more discipline. It also does take a lot more planning. When you start taking funds out of your RMD, when you start taking funds out of different accounts, you have to really plan exactly what you're going to get, and also knowing the balances, where again, in a traditional account, if I'm sitting on $1 or $2 million, it might make a lot of sense to start converting that once I do retire, if I don't need the funds, but start doing some of that Roth conversion. So taking some of the money in those IRA accounts, start turning it into a Roth conversion, paying taxes on them, and making sure that we're getting some of the money, or really stacking up a lot more money into the Roth accounts. When again, you start looking at these RMDs, they're saying in 2033, which I know a couple years out, 9 years out is quite a ways away, but the RMD age at that time is planning to go to 75. So again, I think another 9 years, I'm going to be 54 years old, not even close to the RMD age, but they're going to be moving it and plan on moving it to the age of 75, because people are living a lot longer. That could make a really big difference with how much we have in the account and exactly how we do take our funds out. So, all right, guys, so definitely you have to plan if you're doing early retirement, late retirement. If you want to retire in your lifetime, you really have to know and create a very substantial withdrawal strategy, so you know exactly you're not going to run out of money during retirement, and it is going to be fully funded to the retirement that you want. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think, and as always, thank you guys for watching. The rate reductions are finally coming. We seen our first one in September, another one followed in November, and we could see a third rate reduction in December of this year. And what does that mean for your finances? When we start looking at a lot of savings rates, CD rates, even high yield savings, a lot of those rates are slowly disappearing as the Fed continues to reduce rates. Now, of course, in an interest rate reducing or falling environment, it does make money cheaper for companies, but it also really puts people like myself that want to save money into a pinch. So in today's video, we're going to be looking at the 8 best places to put your money as rates continue to fall. Now, overall, with the rate reductions, we could see it into 2025, into 2026. We don't know exactly how low or how frequently they're going to drop them, but it will have a big impact on your finances. Now, the first one we look at, and this is one that I've done a lot being a financial center manager, longer term CDs. So a lot of institutions have like a 9-month, an 8-month, and then they have a longer term, an 18-month, a 24-month. A lot of people are starting to put money into those longer term CDs, because essentially what they're looking at and what the forecast is in 18 months, in 24 months, rates are going to be significantly lower than what we're seeing today, meaning when that CD comes due in 18 months, the rates are going to be considerably lower than where they are today. Now, by locking in today's rates for 18 months, for 24 months, for any tier or longer CD, you can really lock in the benefit of having that higher interest rate, where even right now we have 9-month CDs that are around 4.8%, and we do have some 18-month CDs that are around 4.6. So still seeing a very high interest rate when it comes to not only the short-term CDs, but also those longer-term CDs. Now, with CDs, you know they are FDIC insured or NCUA insured, depending where you're keeping them. And that gives a lot of people during retirement a peace of mind and a steady ability to get income. Now, when we talk about very steady, the tried and true, a lot of money moving out of the financial institutions and going into Series I bonds. Now, Series I bonds, they do keep pace with inflation, and it is really good to have these bonds. Now, you are limited to how many bonds you can buy, but overall, it really pays two types of interest. One is a fixed interest that remains in place for the entire life of the bond. The second one is the inflation adjusted rate, which can change every 6 months. So again, when you think of the bond, you're guaranteed that fixed rate, but you could also see a bump depending on where inflation goes, and also depending how long you hold these, because remember, these are issued and you can get interest for these for 30 years. So a couple years back when interest really peaked at around 8.2%, you were not only getting that inflation adjusted rate, but you were also getting another higher rate on the fixed rate, which made the I bonds really highly sought after. But of course, a lot of people didn't realize two things. One, you were limited to how much you could buy. And two, you could also, at some point, not only could you only buy a certain amount, is you had to hold them for a certain amount of time. That was the second part that a lot of people didn't realize. Now, staying on the same side, they do have TIPS. Now, TIPS is Treasury Inflation Protected Securities, or TIPS. This is another one that is a built-in inflation protection component. Now, when we think of Warren Buffett, he put a ton of money into government bonds. When you start looking at most Treasury securities, they pay interest, but unlike Treasury securities, the principal adjusts for inflation. Again, meaning if inflation does increase, we know it's going down right now, but it doesn't really, we don't know how fast it's going to and how far down it's really going to fall. Now, other types of bonds, you could look at corporate bonds, you could look at municipal bonds, you could look at a lot of different bonds. And of course, if you're buying the bond now, it is going to hold up for later, but the value of the bond as rates go down, the value of the bonds do decrease as new bonds are issued because they're issued at lower rates, which is the reason why a lot of people want to lock in those longer term bonds today, knowing again that inflation rate is going to be coming down in the near future, or those rates, the Fed fund rate is going to be coming down in the near future. Now, if you want to get out of bonds and you want to get into something a little bit riskier, peer-to-peer lending, when you think of Prosper, when you think of Upstart, there's a lot of institutions that do peer-to-peer lender. Instead of just having the money parked in the savings account, you can actually lend it out to individuals that need cash. In return, you get a higher loan rate depending on the risk that you're willing to take. You could only lend to certain people with certain credit scores, or you could take a lot more risk and lend to that, essentially the E, the D, the C, the lower credit rating. But of course, you could lose money if the borrower that you're lending money to does default. So you have to be very cautious of that. And a lot of them, like Prosper, Upstart, they're the guaranteed personal loans. A lot of times when I see loans outside of, regular financial institutions like your Chase, your Bank of America, or even your credit unions, it is through Prosper, it is through Upstart. It is at a very, very high rate. And usually it is an absorbent amount. I've seen some loans from Upstart that are upwards of like $30,000, but they're at a rate of 30%, which is insane. When you think of that amount of money at that rate, that is a really, really big investment. Now, of course, you could get out of lending in general and go right into investment real estate. Now, of course, a lot of people do pull money out of a savings account, find a place to put it. Purchasing real estate has always been historically a very good place to put it, especially if you're looking to get not only the rental income, but now again, as we're getting into that lower interest rate, if you do have to borrow money, if you do have to get a mortgage, the rates right now are a lot lower, meaning that every $1,000 you put in there, you could see passive income coming in when you're buying a property or when you're having that investment real estate. And essentially the person who's investing it or the person who is renting it out is paying for the house and building the equity in that home that you can use for future use. If you buy it, or if you end up selling it, if you end up doing anything else with it, it can produce a very steady stream of income, which is the same with side hustles. Sometimes you've got to spend a little bit more money to make a little bit more money. And this is where it comes to, again, just the general thesis of investing in yourself. The time and effort in really looking at a side hustle. You could do something like I do here on YouTube. And of course, If you like the content that I'm putting out, definitely subscribe to the channel. But when you start looking at, people going for Pokemon cards, going to yard sales, going to thrift stores, going to estate sales, flipping things online with Facebook Marketplace, there are so many different ways and so many things that you can pick up that are a profitable side hustle. And of course, the one that we're seeing more than anything right now is moving the money from those savings accounts, those CDs, those high yield savings accounts, and moving them into the stock market. Interest rates, as they do climb in recent years, a lot of people really wanted to trim the exposure to stocks. But after all, where you can get 5% in a savings account, where you can get 5.5% in a CD, which is an ultra safe option because, again, they are insured. Why would you keep it in the stock market? Well, now's the point where the CDs are starting to go away. High yield savings accounts are doing the same. So a lot of people are moving it into cash or moving it right back into the stock market because that is the place where we are seeing the growth. When we start thinking of the better returns, when we start thinking about the S&P 500, index funds itself are yielding about 10 to 12% over the last 10 years, which is incredible. Now, a lot of people think they're kind of high risk, and I know there is a risk associated with it. If you're buying individual stocks, you could see a much higher risk factor in there. But overall, buying ETFs, and especially if the market does see a little bit of a decline or a correction, 20, 30%, I would absolutely love. It would give me the ability to actually buy the stock market at a much discounted price, meaning that every dollar you're putting in would buy essentially 20% more if we did see that 20% reduction in the stock market. Now, I know most people don't like to see their portfolio and the balance of that portfolio go down, but there is no point in history that the market is going to go up forever. We need those correction years. We need those years where you're buying it with your 401k, when your investment portfolio, with everything else where you're buying it at a discounted price. It really does make a big difference. All right, guys, so that is 8 of the places and the best places to park your money as we're continuing to see these rates fall. And of course, as we continue to see rates fall, especially when it comes to the market, we do see a lot of companies, as money gets cheaper to borrow, they see a lot of ability and really the ability to fund projects. When we think of AI, when we think of upgrades, when we think of, outdated technology being essentially revamped, replaced in smaller companies, even looking at the small caps and the mid caps, there is a big runway for those once money does get a little bit cheaper. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.